Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trade in the stock market. In today's episode, we are going to talk about taking the better trade versus the best trade and how to distinguish between the two. Now, the person who is writing today, he's a member of the Trading Block and he's a fervent listener to the podcast. And he's provided me with some great material in the past. And here he's provided me with some really good, unique topic discussions here today. So we're going to call him Uncle Bubba because that's the name that he went by before. And if you're wondering why in the world is he calling somebody Uncle Bubba, I'm from Florida. I consider myself redneck. I've been trading for 30 years. That doesn't mean that you can't be a little redneck as well. But anyways, I give everybody a Florida redneck name because I don't want to use their true identity on the podcast because you never know when they might down the road hate the idea of having their identity used. So in any case, we'll stick with Uncle Bubba for this email. And Uncle Bubba writes, "Hey, Brian, Uncle Bubba here. Last time you used a question on the podcast, I was referred to as Uncle Bubba, which is what we're doing again here. This year so far in the Trading Block has been eye-opening and then some. When I wrote to you last time, I was beat up, battered, and bruised from trading in the stock market and getting knocked around on the internet and the market as a whole. So much noise, so many obstacles out there, but I was determined to find my way through all of that. In a course of just a few earnings cycles, the Share Planner community has stood me up, dusted me off, and got my head screwed back on straight. I have leveled up in all ways, including new tools and better trading platform, but more importantly, a better understanding of the story a chart is telling you over time. Just recently, I've started using the playback feature in the Trading View, and I highly recommend it. I'll pause it at any point in the past and see if I can anticipate direction based on my most reliable indicators and analysis of the chart. Then play it forward day by day, like using flashcards to memorize patterns. This has built up my ability to interpret what I'm seeing on the charts. Having your custom analysis on the live streams and Discord channel is a huge confidence booster. You've kept me out of some bad trading decisions and encouraged me into some really good ones, especially lately. I've even bought some profitable trades to the group, which is a great feeling too. Things seem to be clicking on a whole new level. And with that comes a new level of challenges. I'm at the point where I feel good about ruling out bad trades, but what I'm trying to understand now is how to choose the best ones or the best of the good ones. How do you determine the best reward to risk ratio from a list of healthy looking charts? In other words, how do you judge the reward part when flipping through the charts on a regular basis? And then how do you compare the potential to take only the best of the best? For example, let's say energy is leading and we can have 5 solid looking charts in that sector, all with similar share price and stop loss points. What is the rank that causes one of those to stand out or score higher? Like a poker pro, I'm sure you start getting familiar with the odds for certain setups. Some patterns are more reliable, so are some equities. But all things being equal, how do you judge the risk versus reward across those good looking charts? This is a great problem to have, by the way. There are so many hours in the day and so many positions that I can hold at once. When things are going well, strategy means deciding what not to do. Choosing between a bad trade and a good trade is a lot easier now, but choosing between a good and a really good one, as it turns out, is not so easy. Thanks for everything, Uncle Bubba. Now, it's great. And I don't think that there's always perfect answers for some of these questions. I'm going to give you my best thoughts on it, my best analysis that I can provide. But in the end, we're all beholden to the market and what it decides to do. So a couple of points. First off, I love this idea, and I can't say I've really done it in the past except for maybe a few times, but for a new trader, what a great idea going back and looking at some like charts, and you can really choose like any time frame depending on how far back TradingView will let you go. But going back in time and just going through a chart, finding a setup, and then trying to figure out how you would manage it and go day by day to figuring out how you would handle the stop losses. Because if you go back in time far enough, you're not going to remember all the price action. Like for me, I can probably chart SPY, not perfectly on a day-to-day basis, but if you gave me a pad and paper, I could take what you have in SPY and probably chart you out the patterns that took place over the last 10 to 15 years. But if you're going like, let's say Wayfair or CMI or anything, you could go take any stock, Palantir, and go back years and then just try to see how you would do the analysis on that particular chart and whether or not there was a trade setup. And then how you would manage the trade. And it is a lot like flashcards. I remember growing up, we had these vocabulary tests in our English class, and you had this little thin book. Every week was like a set of 15 new words. And you would have to know actually it was 21 words. I don't know why they did it 20. Maybe it was 20. Actually, it was 20 words. 20 words. But the way it worked is my mom was very involved in this. Every night I had to memorize 7 words. And I had to memorize the definition, if it was a noun, if it was an adjective, and how to spell it. And then on Friday there was a test. And my mom always felt like, if you're going to get an A in English, this is one of the best ways to do it because you have a test every week. Just memorize the words. I hated it because she would go over it with me every night. And I'm thankful looking back to that now. But what's so crazy about that is that I would memorize these words. I'd do 7 on Monday, another 7 on Tuesday, and then 6 on Wednesday. But on Tuesday, I would not only do the 7 new ones, but I would also rehash the previous 7 that I had learned the day before. And then on Wednesday, I would rehash the previous 14 from the previous 2 days and then learn the new 6 new words on Wednesday. And then on Thursday, I would do all 20 words. And then Friday, I would take my test. I think she even made me wake up early and make me take that test. But what's so cool about that is so many of those words that I use now came from those vocabulary tests. And so I'm glad that I took them. Tedious? Yes. Annoying at times? Yes. Especially for a teenager. I didn't care what some of these words meant. Now as an adult, especially as an adult who does a podcast, kind of big. So a huge thing for me. And it's just like that with the going back in time and be able to look at some of these charts. It's a lot like the vocabulary test or like flashcards or just memorizing. You're learning these patterns. You're learning what you're seeing and you're learning how to react to them. And while it might seem tedious right now, down the road, that can really be a valuable experience that you gave yourself early on. I wish when I first started trading, the tools that are out there now were there back then, and they weren't. It's just like with sports right now. I played quarterback in high school and got my head handed to me on a weekly basis. And I look at some of the tools the kids have now. I'm like, how are you guys not just phenomenal athletes with all the tools that you guys have? I mean, there's so many things that teach you coverages and teach you how to read defenses that I never had. I mean, I was like watching VHS, just trying to figure out anything. Nobody was teaching me this stuff. But same thing with trading now. You have so many tools at your disposal. Take advantage of them. And in the case of TradingView and being able to go back in time and look at these charts, that's awesome. So that was one of the points that I wanted to mention. And then Uncle Bubba, he mentioned how he's part of the trading block, and he's adding really good trades to the group. And that's one of the cool things that I love to see in the trading group, especially people who come in, they're new, and they just jump in there, they get their feet wet, and they're not afraid to be right. They're not afraid to be wrong, and they're just willing to learn. And eventually you start seeing them bring some really good trades and setups to the group. And a lot of times, some of my best trades comes from what other people are recommending. They see a chart, and I'm like, holy cow, I missed that in my scans, but that's a really good chart. And so I take the trade myself, and I benefit from it. So lots to cover here in this podcast. We're going to get to the better trades versus the best trades to take. This first question is, how do you determine the best risk-reward ratio from a list of healthy-looking charts? Knowing your risk tolerance is one of the first things that I would say. There's a lot of good charts out there that I like, and I've noticed it a lot. Just even today, I was looking at different setups there, and I was getting a little bit frustrated from the standpoint that I couldn't find something that fit within my risk tolerance. And I think that is something that's very well overlooked in our own trading, that we'll make exceptions to that. And I've done a lot of podcasts on know your risk tolerance. It's important to know how much you can handle losing on a trade before you start to lose your marbles. In the end, we want to make trading as boring as possible. And in doing so, we want to make sure that the risk tolerance is at a level that doesn't cause us to overreact or get upset in our trading. And so when our risk tolerance isn't tuned in just right, we'll start taking trades that we probably shouldn't be taking. So one way to eliminate, some of the trades out there is by eliminate the ones that don't fit your risk profile. For me, I'm not really excited about taking trades where I have a chance at losing 10% on the trade because it doesn't fit into my risk tolerance profile. So when I come across trades, and I came across a lot of those today when the market was rallying, I saw, okay, this is a 10% stop loss, or this is an 8% stop loss. I'm going to pass on those. And you have to do that because you're trying to trade within your risk tolerance. Because if you start trading outside of that, you're going to know fairly quickly you're trading outside your risk tolerance, because your trading decision is going to become very sporadic, and it's not going to be well contained in terms of managing the overall risk. You're going to get out when you should stay in, and stay in when you should get out. Also, I think knowing the market conditions is a huge part of that. So when you're talking about finding the best risk to reward ratio and you see a market that's struggling at all-time highs and it's starting to pull back some, if you're looking to try and get long on a stock and the best reward risk ratio requires that you take like a 7% stop loss, well, if you're going to get 2-to-1 return on that trade setup, you're going to have to see a 14% return in order to justify that 7% stop loss. But if you're at a market that's really struggling, you're seeing semiconductors pulling back, which they're not doing right now, but let's just say for example's sake, semiconductors are pulling back, but you want to get into NVIDIA. That doesn't make a lot of sense. There's times too where you can, let's take NVIDIA for instance. If I saw a perfect trade setup and it required a 25% stop loss on it. Okay, well, that trade's justified. In theory, that trade is justified if you think that you can get 50% out of it. But just because you think something doesn't necessarily mean that's what's going to happen. So we have to be realistic with what our expectations are of a trade. If we're getting into a stock with a 25% stop loss on a stock like NVIDIA, are we really thinking that during the duration of your trade that it's going to add an additional 1 trillion plus to its market cap? I wouldn't expect. Actually, more than that, it would be like 2 trillion. Because if it's going up 50% and you're taking a 25% stop loss, that's really not that realistic. You would have to have something that was a game changer in addition to already what's going on right now in the AI space take place. It has to take place within that 3 months that you're holding it, no more than 3 months. And that's assuming that you get in the day after the previous earnings. Because remember, the longest, if you're managing risk on swing trading, the longest you can hold a trade is for 3 months, because you run into earnings and you got to get out because you're not holding a stock through earnings, unless, at least I'm not. So knowing the market conditions, knowing what you're up against, what are the tailwinds, what are the headwinds that you're facing in the stock market, knowing your risk tolerance as well. And then how do you compare the potential to where you're only taking the best of the best? Well, for one, reward and the reward ratio, it's not a concrete thing. For instance, I'm in a trade right now at WDC, and I'm on the last leg of that trade, and that last leg of the trade is up over 40%. Great trade. I'm excited about that. I got in at 76. It's trading, I don't remember what it was even trading at. I think it hit like 105. So really good overall returns on that trade. Did I get into the trade thinking that it was going to go to 105? No. My target was probably around $86 or $87 on that particular trade. But if I would have made my target price concrete and it goes right up to 86, I would have already been out, and I missed out on an easy additional $19 because literally it's just been like straight up. It's been running with the AI stuff, and it's just been pretty much parabolic. I think there's been 1 day or 2 days that it's had that's been to the downside. But if I limited myself by what I thought the stock could do, then I would have missed out on a whole chunk of profits on that particular trade. So we can't let what our target expectations are, just as much as we have to understand our conditions, we can't be limited by them either. So we can't be limited by our profit expectations, because sometimes a stock will run much, much further than you ever expect. And WDC is a perfect example of that. You're seeing it in a lot of other ones. If I was an MU, that would probably be one that went way beyond my expectations for the stock. One thing, though, that doesn't go beyond your it does go beyond your expectations, actually. I shouldn't say it doesn't go. It does go beyond your expectations, is the self-made trader. Trying to segue into that was kind of a bust right there. But anyways, the self-made trader is my all-in-one, all-encompassing training course on how to trade in the stock market, specifically from a swing trading standpoint. It's taken me over 4 years to put it together. It's been really my life's work, over 25 hours of video shooting. I did it all on my own. I did the editing. I did all of that because I wanted to make sure that it encompassed everything that I wanted a swing trader to know and to be able to benefit from. So check that out by going to sharepointer.com. You can click on Trading Academy and it'll show you the Self-Made Trader. Check that out. Buying it, you're definitely supporting the show and doing so. And I think you'll really like it as well. It's going to teach you everything that I've learned over the last 30 plus years of trading. Now, another point that we want to make, he talked about poker, right? He says, I'm sure you get familiar with the odds of certain setups and what patterns are more reliable. Very true. And a perfect example of that is the head and shoulders pattern. Head and shoulders pattern is notoriously a bearish pattern, but more oftentimes than not, I see these bearish head and shoulders patterns turn into an amazing launch point for longs. You hit that, you form this beautiful head and shoulders pattern. I would say this has been something that's been consistently taking place well over 10 years now. But you get this nice head and shoulders pattern and you think that it's about to confirm. And a lot of times it does confirm. It confirms by just a smidge. It'll get a lot of people to buy into the initial breakdown. And then either it'll come right back up and recapture the neckline, or it'll just bounce right off of it, won't even break below it, and create this huge launch pad off of the neckline, which is acting as support to the upside, nullifying the pattern and just taking off to new all-time highs or whatever, negating the pattern at least. I've seen that happen a lot. And that's part of like learning the odds with experience and time. You start to pick up on some of those things. Another one would be the descending triangle. That one, a lot of people get bearish on when they see it. But more times than not, I'll see that one break to the upside as well, especially in a bull market. And knowing your market conditions also goes hand in hand in understanding the probabilities of certain patterns and setups working out. I see a lot of bearish setups right now. If I took every bearish setup that I was seeing, I'd be just getting destroyed by those bearish setups. There's plenty of bearish setups out there, but you can't just take them because there's a setup. You have to know your market conditions. And right now, the market conditions is new all-time highs on multiple times each week. And so why short that? Why go against that? Because you're just going to be fighting a trend that you're not able to slow down. The market doesn't care if you're short. It doesn't care if you're bearish on something. All it cares is that it really just does what it wants. It doesn't care about the individual trader. It's going to do what it wants. So following the market, following its lead, and not trying to put your own opinions or try to put your own desires on the market or attributing variables that the market doesn't care about is something that we have to avoid as traders. We have a whole bunch of points here, guys. The fifth one here, he was asking about how are you able to judge the risk reward against all the good looking charts? So let's say you have a lot of good setups in the financial sector. And I actually came across this one today. RF, I got stopped out of a couple of weeks or a couple of days ago for a decent profit. Nothing big, nothing bad. But I was taken out of it. But a new pattern developed. It developed against a rising trend line, and it developed a nice bull flag, and it started breaking out. But I also saw where SYF was breaking out in credit services, and I saw a whole bunch of other regional banks like CFG that was setting up. And the idea there could have been, well, should I avoid RF just because I had been taken out of it a couple of days prior? No, not at all. In fact, it sometimes will feel like a revenge trade, but I always like it because I do try to not just trade the same stock I just got knocked out of unless it's a really good trade setup. And in this case, the chart had evolved over the 2 days and it created a really nice setup there. So I took it. Now, there was other setups, but why did I not take those? Well, for one, you may have had some that weren't ready to break out just yet, but I had RF right here and I was wanting to add more long exposure where it was breaking out. Or you may have one that it was a good setup, but the reward risk ratio might have had too wide of a stop loss. Or in some cases, it may have had the same stop loss as the one that I wanted to get into, but there was resistance overhead. Oftentimes I can get out of a particular trade setup by, and completely ignore it altogether if there's resistance right after I get into a breakout on that stock. And so, for instance, a good example is if you get into like a bull flag, it breaks out, you get long on it, and then you start noticing where previous price history keeps banging off of the 50-day moving average that might be hovering just above it. Well, if you see where it's like 3 or 4 times in a row where every time it tests it, it it gets rejected, that's a good sign to probably move on from that trade. You want as much clearance for it to run overhead without any kind of a pushback as possible. So really, yes, choosing between different trade setups that are really similar in the same sector and showing a lot of potential is not easy. But you want to think about your risk tolerance. How much are you risking? How much is the chart demanding that you risk? Is the support, is the stop loss placements? Which one has the better stop loss placement? If I can find a much more longer trend or longer standing support level that's there that I can put my stop loss over, I would rather do that than like putting my stop loss below the day's lows from the day prior. All of that has to go into consideration. The market conditions, knowing your risk tolerance, realistic reward expectations for what you can expect from the trade. You don't want to just assume that the stock's going to go higher just because you want it to go higher, just like that NVIDIA example that I gave earlier. So that about wraps it up here. If you enjoyed this podcast, and I hope that you did, make sure to leave me a 5-star review. And if you want to support the show, check out the training courses that I have available on my website. Also, my monthly service with the trading block where you can trade with me on a daily basis as well. You can go there. It's all at shareplanner.com. Really cool stuff there that can help you enhance your trading abilities for the long run. Also, make sure to send me your questions. Ryan@shareplanner.com. I do read your emails, and I still am looking at making this a 2-a-day-week podcast once again. I've moved locations and still trying to get set up. That's why you haven't seen as many videos on YouTube and on the podcast as well. But we're getting there. We're getting all set up, and it should be getting things back to normal here very soon. Remember, guys, Jesus Christ is the way, the truth, and the life. No one comes to the Father except through him. Thank you, and God bless.